Hello, everyone, and welcome to week 2 recording. Now, today we are talking about financial institutions risk, and I have chosen to divide this recording into 2 parts. The first part is around 26 slides, and we are going to talk about financial institution risks. In other words, we are going to talk about the entire matrix of bank risk. But in this part, we will only talk about the definitions. Later on, which means we will take all those 10 risks and we will define each risk individually. We will talk, maybe give some examples about it, but we are not going to do anything further than that. As you understand, when we talk about risk in this class, which is the coverage of the whole semester, each risk should be defined, should be measured. When we know what is it, we know how we want to know how much is it. So we want to take an action, and action means managing it. So it's a 3 steps: define, measure, and manage. Now, in the first part of this lecture, as I told you, the 26 slides, we will only define those risks. Now, in the second part, we will take one of them, which is the interest rate risk, and then we will start to talk about it more in terms of measuring that risk and talk a little bit of management. Now, the first part should be easy and straightforward, but the second part will go to some modeling, whatever. So having said that, please allow me to share my slides and start. So this is actually the first slide, and we are talking about, this is part 1. And as you know, I will always remind you of this slide, which means this is how our semester looks, or the risk, or the topics in our semester logs. And therefore, we are going to talk today about all those type of risks, We'll all define them. And then in the second part, as I told you, we will only concentrate on the interest rate risk. Now, having said that, this is actually my agenda, and we are going to talk about, as I told you, all those type of risks, which is 10 risks. And then we will talk about, in the second part, the interest rate risk. Now, this is, as I said, this is the second time I say it. This is the first part. Now, I actually, too much time was spent in this mind mapping of the risk of banks. So as you can see, those are the 10 risks, from 1 to 10, as you can see. And let me just, so this is actually all the matrix of those risks. Now, I choose also to define each risk a little bit. So if you want to understand what is interest rate risk, this is the definition of interest rate risk. This is the other definition. I mean, if you are studying and we are trying to see, just to map your mind around all those risks, this is a good slide to look at it. Now, if you go a little bit here, now there is some more discussion about it. But still all of those things within the definition. Either you choose to, maybe you want to review things fast, you can look at those things. But the following slides, actually, the following 25 slides, will talk about each one in terms of the definition and more details. Okay, let me now go to this first risk, which is interest rate risk. So the interest rate risk, I will not spend a lot of time here because it's the subject of my part 2. So it's the risk incurred by the financial institution if there is a mismatching between the maturities of assets and liabilities. A mismatching between assets and liabilities is a fact of life in banking. Because as I told you, if we are not going to do mismatching, now we kill the whole intermediation function of those financial intermediaries. So we have to take small deposit, we have to take short-term deposits, and we have to give long-term loans. Now, sometimes the case could be opposite. I can take a little bit long-term deposit, like I can take a long-term deposit of 3 years and finance a loan of 1 year, a business loan of 1 year. This may happen. It's not always one side. So because of that, there is mismatching. So what? The mismatching will cause the following. If the interest, and this is actually the subject of the second part, because if I take, for example, a loan, if I took a liability for 1 year and of 1 million ringgit, and they gave it as a loan, as a business loan for 2 years, that 1 million. End of the year, the liability holders, which is the depositors, will come and liquidate their deposit. But the problem is their money is already captured in that loan for 2 years. I have two options. I have to borrow, I can take another deposit and retire this deposit, give it, pay it back and settle it with the depositors, and take another deposit from other people. So their money is kept in the two, as I told you, in the 2 years loan. So I can take another deposit from somebody else and give it to this depositor who deposited the 1 million beginning of the year, and they can settle with him. Or I can negotiate to roll over, which means extend the liability, this deposit for 1 more year. And this may happen, and it's not difficult to get deposits. The problem is if the interest rate now change. If the interest rate now change, then I have a problem. Because now, if I take the deposit for 6% and they give a loan for 7%, I have 1% profit, which is the net interest income. The problem is if after 1 year, the interest rate increases and become 8%, which means I have to renew the deposit for 8%, while those loan, my borrowers, is only giving me 7%. So I'm already losing 1%. So actually the changes in the interest rate, not only 1%, 2%. I used to have 1%, now I will have minus 1%, which means if you add them to, it's the impact on the net interest income is 2%. This is basically the impact of the interest rate on the, this is the impact of the interest rate on the income statement. But also, if there is an increase of the interest rate, it can impact my assets and liability. Because the net worth of my bank is actually the asset, the market asset, the market price of the assets minus the market price of the liabilities. Now, if there is no matching between the assets and liabilities, this is in the balance sheet, when the interest rate increases, of course, the value of I have 100 million ringgit of bonds and the interest rate increases, the price of the bond will go down. See, the interest rate has two problems. One of the problems is it will impact my net interest income, and that's we understand it. As I told you, when we want to rule the deposit, and the other thing is if I am holding assets and the interest rate increases, then the price of my bonds will drop, because the price is actually the cash flow over the interest. So you discounted, the price will be now down. Somebody will say, also my liabilities will go down. That's right. My liabilities will go down. But if there is no matching between the assets and liabilities, there could be a minus impact on the net worth. So as I told you, the price now Any price is actually the cash flow over the 1 plus I. This is just a simple discounting, right? I'm talking about this I now. I'm talking about this. I'm talking about this I. If it goes up, this price will go down. And this is the problem with the interest rate on the balance sheet. So this is for the balance, excuse me, this is the balance sheet, and this is for the, we have also another problem with the net interest income. Now, I will talk about this when we get to the interest rate later on. Okay, let's go now to the market risk. Market risk is easy to understand. We operate in a market. There is no problem, for example, inside the bank. We have no problem with the risk inside the bank, but the interest rate outside the is changing. The exchange rate is changing, and also the asset prices, or the what we call the equity prices, is changing. So if there is a drop in all those, if there is an impact of the interest rate, if the interest rate change, exchange rates or asset prices, that actually will impact my investment. It depends on my positions, what positions I'm taking, because you see, my assets are divided into parts. One part is the loans, which we understand it. The second part is the my investments and bonds and securities, stocks, derivatives, whatever. Those are very, very sensitive to the changes in the interest rate, exchange rates, or asset prices, which is the equity market. So market risk is closely related to interest rate risk, foreign exchange risk, and equity risk, which is actually related to those risks. We know the interest rate risk has a problem, but also the market risk involve interest rate, foreign exchange risk, and equity risk. Now, bank have trading book, and this is what I will show you in a minute, which is a new concept. I want you to understand it. There is something called trading book, and we have something called investment book. I think what you know until now is only the investment book. And the investment book means when we are, say, one of those, a public bank today acquire another company, like a small insurance company, or a small fintech company or a startup. It's an investment, and they want to keep it for a long time. And you can see it in the balance sheet under investments, and it's in the banking book. But there is something called trading book. Trading book is, it's my inventory of bonds and stocks and securities and even commodities and derivatives, all this package, which I traded in daily basis. So actually, I have no intention to keep it till maturity. But that startup, which public bank buy, or the small insurance company which he acquire, which public bank acquires, they need to keep it as part of their business for a long time. This one, there is no intention to keep it for a long time. They just want to take the profit of the trading. So we call it a trading book. Now, industry example of dangers of market risk. We have this Bearing Bank, and I think just if you Google Bearing Bank, I gave you the link, but the problem, then I uploaded for you a PDF file. I don't know whether you can click the link or whatever, but you can just Google Bearing Bank. Bearing Bank was here in Singapore. There was too much trading in Singapore and in derivatives, and they make losses around 1,400,000,000, and actually the asset was only 860 million, the capital. So Bearing Bank could not. So the losses was around 1.4 billion, and they have only 860 million, which is capital. So the bank was collapsed, and that was because of derivative trading. That guy was crazy, man. Yeah, they take positions, the Japanese currencies, and then stock market index, and then they lost that problem. It was a derivative problem. Now, when we talk about cases, I just gave it to you for examples. You don't have to worry about it. And this is why when you see this hint, when I say it's not examinable, which means I'm not going to ask you about Bearing Bank, whatever. It's just an example as we are progressing. But it's not, I just want you to understand the definition and why it happens. Now you can Google Bearing Bank. It's 1 page or 2 page. You can read it if you like, and you will see what happened. So coming back to our issue of the trading book. Now I already, explained to you the banking book and the trading book. Now let's talk about the banking book, which is actually the balance sheet, which we always know. That we have cash, loans, premises, and other liquid assets, and we know our liabilities, this one. And those ones, or this one, we keep it till maturity. But now, if you look at this area, which is the trading book, this is where we trade. Now, when we trade, we can take asset side, or we can take a liability side. Let me get this thing back. So it's our area. So we say here, we go long. And I want you to be aware of the word long. Long means we buy, I told you, there is bonds, there is commodities, banks are trading in oil, they are trading in steel, they are trading in wheat, they are trading in all those type of commodities. They do a big work. And they buy and they wait until the price goes up, then they sell it. They can buy currencies, they can buy derivatives, they can buy bonds, they can buy stocks, they can buy equities, whatever, and then sell it later on. And this is what we call it long. But also they can go short. And the word short means, remember here, the prices are low now. And you want to buy, wait for some time, and then sell in the future. Here, the prices is high now. So what you do is, and you know, in the future, it will be low. So because of this overpricing in the market, so what you do is you talk to your broker, as they do, and broker provide those facilities, they provide those margins, and you ask him that to lend you those bonds or securities. So you take it from your broker as a liability. Of course, we are talking about huge brokers. They will give it as a liability, then you sell it down. Then you wait until the prices goes down, you buy it back. And when you buy it back, you will buy it with I told you the prices now is high, in the future it's below. When the prices goes low, you buy it back and you give it to your broker back. So in this case, actually, for example, the broker can provide you with 1,000 or 2,000, 10,000 shares of SAMDB. And then you sell them now. So he also sell it for your account, but you are in debt and it's a liability and you have to give it back to him. So you wait until the prices goes down, you put it then, or maybe you sell it now for 12 and you wait, 3 months, 4 months, the price goes to its normal 10, you buy it back. So you are making around the difference of 2 ringgit per share. So this is what we say. Now this applies to bonds, to commodities, to foreign exchange, to equities and derivatives. So this is actually the trading, and we are talking about this circle and this area. As I told you, this area is highly impacted by the changes in the interest rate, changes in the exchange rate, and the changes in the commodity and the stock market. And this is all related to this. This is only the definition. Now let's go to credit risk. Now, credit risk is actually a thing most of us know, which is just as easy as this. We take a loan, we give a loan to a borrower, or we buy bonds from an issuer. They default. And defaulting means they fail to pay the interest, or they fail to pay the principal, or they fail to pay both, or they fail to pay on time. So it's either interest problem or a principal problem, or both of them, or they don't pay on time. All of this is considered to be defaulting, and I will show you how it happens. Now, this is what you call the limited, the large downside risk, which is the defaulting. So the defaulting is, as I explained it to you, either principal plus interest and delay. These all called defaulting. Now, there is something which is maybe new to you, a limited upside risk. A limited upside risk is actually related to, the limited upside risk is actually focuses on uncertain positive return rather than negative return. What do we mean by that? If we have 100 million, say 10 million ringgits, and we, as a bank, and we invest it in bonds. Now, the return of those bonds or the coupons were 4%, because it was actually the interest rate valid in the market. That was the interest rate valid in the market, which is actually reflected in the coupon rates. And you bought those bonds in bar, which means the interest rate are called the coupon rates. So you put it in bar and you go like that. But later, after 1 month, I didn't know the interest rate jumps. And these people now, the new issues of bonds is now 6%. If this is happening, which means you didn't lose, but actually that opportunity cost, which increases the return from 4% to 6%, is considered limited upside risk. This is a new definition for some other risk, which means actually you did not, there was no enough planning to see the changes in the interest rate, which will go up in the future, which have caused you to lose some positive return in the future. So that is the limited upside risk. It focuses on uncertain positive returns rather than negative returns. So fixed income coupon bonds, upside risk losses due to the increase in coupon yield in the market. That's what we mean by it. What about large down risk? It's already what I said here. So if you allow me now to go, I will go to the next slide. I continue with credit risk. There is also another definition of credit risk, which is firm-specific credit risk or systematic credit risk. And what do we mean by firm-specific credit risk? For example, you gave a loan or you bought a bonds from one company. Say you bought it from Apple phones, whatever. And because of the G5 generation of internet and this development in technologies, maybe Apple is not doing well. And in this case, your investment in Apple is going down. And this is actually my investment either as a bond, or maybe I'll give them this. If there is huge banks giving them these loans, you can talk about any company, but we are talking about this phone company that you know. So smartphone companies. So in this case, if they are subject to huge competition because of the G5, then and then they cannot compete with the Chinese or whatever, then in this case, they will not be able to pay their loans back. And this is actually related to Apple, but it doesn't mean it applies to Samsung. It doesn't apply to Huawei or any other phones or maybe any other competitor. And this is related to that company. And this is what we call it firm-specific risk. But then it could be systematic credit risk. Maybe Apple is doing very well. Maybe everything is fine. It's just there is a collapse in the market. And when I mean, what I mean by collapse is that the economy is going down everywhere, like what happened during the global financial crisis. Everybody, as I will show you now in some of the charts, were defaulting. That is actually a credit risk. It's a market risk, become a credit risk in the market and impacted everyone. Because these people want to take, for example, they started because the market is down, they cannot collect their dues from their customers. And because they cannot collect their dues from the customer or account receivables, they can't also pay you. It's not because of them, it's because of the market. So please understand the difference between firm-specific credit risk and systematic credit risk. You can give a loan to a company, either big company or small company. It's there if there is a problem within the company itself because of competition, of corporate governance, or fraud inside the company or whatever, or regulation problems, then regulatory problem or maybe problem with compliance, whatever, with that company, they cannot actually operate well, then in this case, that's firm-specific. But if the company is well and everything is fine, and there is, a market collapse that affects the whole economy, the whole industry, which make this company unable to pay their dues, that is actually what we call a systematic credit risk. This is how I want to, I make this in blue color here, in blue font. If a house bubble bursts, banks are exposed to credit risk. Why? Because all those borrowers of all housing loans may not be able to pay back from their real estate. So this is actually all borrowers. It's not the borrower could be good, but the whole industry or the whole sector is down. So firm-specific credit risk can be managed through diversification. As I told you, if I'm going in a bank, how do they manage their credit risk, which is the firm-specific, or which we call it unsystematic risk, by diversification. So I give to technology companies, I go to manufacturing company, oil companies, tourism, whatever, all of those become portfolio for me. I calculate that portfolio very well. I know some of them will lose, some of them will gain, but at the end of the day, because of diversification, I can get rid of this risk. Can I get rid of this risk? The answer is through diversification, no. The answer is no. Diversification does not help here. You diversify with what? This is a market risk, Okay. I think we have talked about that. Let's go to this one. Let's go to the measurement. Actually, it's not measures. So many measures of credit risk. We have credit scoring. We'll talk about it in week 7 and 8. But if you go now to the regulator, which is Bank Niagara, for example, and you want to look at that, you will find some indicators. So non-performing loans. What is non-performing loans? When I told you credit risk can be measured if somebody delayed. So it's either you don't pay the principal or the, as I told you, principal or interest, or you don't pay in time. Now, if you buy a car now and you want to pay it back, and you are late for 3 months, 3 consecutive months, you are actually defaulting and they can take the car. Not only that, the bank will report this loan which you have to the central bank, and it will be measured as a credit risk for your bank. So if you go to Bank Nigara and you see MBL, non-performing loans, we call them MBL. MBL in Malaysia is 1.5. There is Bank Nigara actually report those numbers on monthly basis. Not for each bank, but for the whole industry, for the Islamic bank category and for the conventional bank category. So non-performing loans is the loans that are not paid in time, and it is actually an indicator of credit risk. What do you think? If you look in Australia, this is, for example, the business, and this is the personal. Business being the companies, personal, me and you, and this is the housing loans. And actually, you can see how do they increase. They go up to 3%, 4% of all borrowers. And when did that happen? During 2007 to 2011. That means what? During the financial crisis. So actually, there was some type of market risk, in my opinion, that led to what we call systematic risk, systematic credit risk, which led all those people bankrupt or unable to pay. This is, but for us, still, it's a credit risk. And regardless of how it happens, I'm just trying to give you some conclusion here. If it happens during 2007 to 2011, this is the time of the financial crisis. Actually, the peak is here, which is 15 of Lehman Brothers collapse in 15 of August 2008. So it's in this area. This is Australia. Australia is supposed to be strong in banking, but still in other countries, you will see this graph is high. I will show you one for Malaysia. The other one is the bad debt. The bad debt, see, if bad debt means you already write it off. You already write off the loan, which means if you give a loan now to a customer, and then the customer default, for example, a house, then in this case, just to give you how banks work, then you cannot go and take the house. You go take the house, the family is there. I don't know what. Then you have to go to the court, and in the court, you know, they try to do whatever they do. If the case in the court is not ruled for the bank, so the bank will write off that loan, and it will be bad debt. Bad debt, which means it's gone from the account. Or if there is a company that you know, seek protection of bankruptcy. So if there is a company which has problem, there is in the law, they have to seek protection by asking regulation protection by announcing their bankruptcy. So to protect what they can do. So in this case, if the banks cannot get anything from them, they will take those loans, take those loans and write them off. So this is a bad debt. This is delay. This is no payment at all. Let's see, in Malaysia, for example, it's not a bad debt. I take this from public bank, from my bank. It's not a bad debt. It's not a delay. It's a loan reserve, which means now there is suspicious that those customers will not pay. So in this case, you have to let this year income statement take some of those losses. So it's not a write-off. You still follow the customer, but you make a reserve in case they, so when you report the net income, you report it after taking those loan reserves. And they always take loan reserves. So loan reserves in banking, a huge loan reserves means this bank has a lot of credit risk. So this is the third indicator. Now we go to another one, which is, we call it off-balance sheet risk. Off-balance sheet risk is actually, it's a contingent liability or asset. Maybe this This term is new for you, but what we mean by off-balance sheet, these things are not written in the balance sheet yet. And the banks do so many things that does not show in the balance sheet. For example, they can provide services like transfer the cash of other banks from the airports to the ATM machines to the branches. One of the banks maybe will serve all the banks here in KL. And if an accident happened, like a robbery or a problem or stealing, or while they are moving that cash, a loss or damage or fire or whatever, then in this case, the bank has to pay it. This is a liability, and it's a contingent liability, but it doesn't show in the balance sheet. I will give you another example. Banks issue guarantees. For example, if I went to the bank now and I want, say, to go to some type of business or some type of contract and ask for a guarantee, say 1 million ringgit, to prove my seriousness about going to that contract and honoring that contract and not breaching it. And before I breach it, so I give them the 1 million. This is guaranteed that I will perform. Just I will perform. And if I didn't perform, then the third party who takes that guarantee can claim from the bank that 1 million. Now, when the bank issue that guarantee, and they issue so many guarantees inside the country, outside the country, whatever, it doesn't show in the balance sheet. It's just one paper. But if there is a claim, it will come a liability in the balance sheet. So in this case, actually, before it crystallized or become actually a claim, it's an off-balance sheet. So we have so many off-balance sheets, like the letter of credits, which is our commitment to pay to foreign banks for importing some cargo for our customers. When we open it, which like a guarantee for our customers. Loan commitments, we issue, we promise to give loans in the future, but we didn't give it now. This, if it happens and we cannot do it, then it becomes part of our off-balance sheet risk. Derivatives, we go to so much derivative transaction, forward contracts, future contracts, option, whatever, nothing is recording. It's only recorded when we settle the contract after some times. If we realize some losses, it will go to the balance sheet, or profit, it will go to the balance sheet. So during that, we are talking about the losses. During when I take, for example, a forward contract now for oil, after 6 months, and I paid in the price, whether that contract is a speculation or is it, hedging, whatever, we will talk about this in the future. But then in this case, it will be a risk. End of the day, what I want you to understand that off-balance sheet is this liabilities or assets that is not shown in the balance sheet. Banks do so many things, they don't record in the balance sheet, but it carries some contingent liabilities in the future. So that is what we mean by the balance sheet. You can talk about letter of credit, you can talk about loan commitment, derivatives, whatever, but understand it within this issue. Now, let's go to the foreign exchange risk. I think everybody knows that. Now, with globalization, now everybody is, especially when we talk about big banks, they are, make investment outside the country. They receive money from, outside the country. So they borrow from outside and they lend to outside and they invest in outside, and somebody invests them from. So when the bank invests outside, either in bonds or in stocks or give loans, the bank will be subject to foreign exchange risk. Now, the risk that changes, and when we talk about foreign exchange risk, it's the risk that resulted from the change in the exchange rates. Now, example, the purchase of government treasury bond from foreign country. If the foreign currency depreciates, the value of the asset and the local currency will drop. You bought something in euro, and dollars, and the dollars today is 4 to $1. Suddenly, the dollar is dropped, and the ringgit is becoming now 3 ringgits equal $1. Then in this case, whatever those people give you as a return, it will not enough to cover your investment. Even if you are gaining over there, when you change it to dollars, then the value in the local currency will be less than your investment. I will give you an example now. So returns of foreign and domestic investments are not perfectly correlated also, which means you can, sometimes you invest outside, people give you deposits, invest inside, and you decide to invest it outside. The return of that you give to your deposits and the return that you get from outside, sometimes in terms of return, in terms of percentage, that is not enough. And this is a foreign exchange also a problem issue. Foreign exchange rates may not be also correlated, which means if you have a portfolio and you are investing in so many countries, your investment, which is Malaysian ringgit to the British pounds, may be increasing while the ringgit to the yen is decreasing. So the only way to do it is all your investment in foreign currencies should be diversified. If not diversified, then you have a problem, which means you have to, and that is a very, very careful thing, how to diversify your investment outside, because only of those changes in the foreign exchange rates. So you have so many problems here. You invest, the rate goes down, then the currency of your investment countries is depreciating. Then in this case, whatever you get there is not covering what you actually invested in the local currency. Also, the returns can be different from your deposits to the outside. And the other thing is you may invest also, but the investment in so many countries and so many currencies, and you have to diversify all of those foreign exchange risk. This is a very issue, if you see this is just an example, you don't have to worry about it. This is the foreign exchange risk example. This is the market data, which is actually from 1960 to 2010, which is the, this volatility of the Japanese yen, the yen and the dollar exchange rate. So this exchange rate of the dollar and of the American dollar and the Japanese yen, see? So if you are American, if you are American bank or Japanese bank, just imagine how can you manage all those crazy things? Or if you have investment, through those countries. Look, this is a very easy example. Suppose now you have $1, the exchange rate is $1. You are an American investor. It could be Malaysian, you can change it to Malaysian numbers, or international student can change it to their currencies. So if it is $1 equals 1 yen, 100 yen, Japanese yen. And you buy 10 shares of Toyota for 10,000 yen. So in this case, each share is 1,000. So actually, your investment in Japanese yen is 10,000. 10,000 per share, which means 1 year later, so you bought 10 shares, and each one is 10,000. So the investment is worth, after 1 year, your 100,000, which is 10 times 10,000 now is 100,000. Because the Toyota is doing well, after 1 year, the price is actually for your 10 shares is 110, and this is the price of your investment. This is a happy news. The problem is the currency. Now the dollar to the yen is 120, not 1 to 100. This is the two things. So because of this, now you are actually under a problem, which means the difference in these two rates have caused, look what happened now. This is the investment now, 110 This is after 1 year, over 120, which is 916. While actually you invested 1,000. You invested $1,000 because you bought 10 shares, every share is 10,000, which is actually $100. So actually you are making 84 losses. So this is what we are trying to see, that the exchange rate, this is just an investment, which is the first case. This is an easy thing to know. There is no calculation in it. And this country and sovereign risk, it happens so many times. Banks go invest in some other countries, especially when they go to developing or less developed countries. There is big opportunities there. But then there is this political instability. There is the actions of the foreign government. They can confiscate your assets. They can prevent, for example, you invest in a big corporation or give loans to a big corporation in some country in Africa or Middle East or I don't know, South America or whatever, or you can go to anywhere. And then the foreign government decided no money is transferred. And they make all those restriction on the foreign currency. Then in this case, you cannot get your money back. Actually, your borrower is good. He has no problem. The business is no problem with it, and they are willing to pay the loans. But the problem is they are not able to do that. This happened for oil companies who are working in all those countries around the world. When you give them loans, governments sometimes confiscate the whole assets. So we have seen all those things. So many examples, which we call country risk. History in the 70s and the 80s, there was all those confiscation of oil company assets in the Middle East and some other countries, which they lost. If they have loans to the banks, it's gone. Now, this is a very clear example. That's in the book. In 1982, Mexico and Brazil government actually, they just say we are not going to pay to Citigroup. Citicorp, which is Citigroup, they have huge loans. They say we are under big problem, and this is where the Mexican crisis started. So this is what we call the Citigroup. So Citigroup is a big banking group. Their loans were not paid because of the government. There was a case here. So there is a little recourse. I mean, you cannot do anything about it if the government decided to restrict the payments. Another good example of country risk was Enron's Indian. This is actually, you can look at this, but if you want to look at this, please look at this. Just Google this and it will show you. I put the link as I told you here, but the link is, I don't know, you cannot get it if it is PDF file. So Enron Indian negotiation, actually Enron invested in power plants in India in 1993. They paid around $300 million when they started. And then later on, a new government come to India and they say, no, we can, I mean, the problem started, end of the day, the contract was, canceled and the payment was not paid to Enron, and that was a very big losses. So this is just another issue. As again, any case I gave it is not examinable. Let's go to technology and operational risk. Now, technology and operational risk is, according to the Bank of International Settlement, which is this is the Basel, Secretary of Basel Committee, actually, who sent regulations and gave, this is the Basel Committee actually was what to call executive branch. So they define operational risk and technology risk as the risk of direct or indirect losses resulting from an inadequate or failed internal process, people and systems. Just simple as this. We have problem with technologies. Technologies is always developing. Either we cannot get the right technology, or we don't get it and we get, we left, left behind, and we cannot catch up with the development in the industry, and we lose our market, or we get the wrong technology, or there is fraud through this technology, bad securities, whatever. Or we have bad people inside, not trained people. So all of this actually could make problems. This is what we call technology and operational risk. Operational is related to people. Technology is related to machines and systems. Now, some financial institutions include reputational and strategic risk as operational risk, which is actually an issue, which means we operate in this what we call trust economy, and we cannot do well, then our reputation as a bank is not good. We lose the market. So if you go technology innovation has been rapid growth, especially in the clearing, SHIPS, clearing house interbank. This is the interbank clearing payments. This is the other clearings. These all systems. And now we have this financial technology, crazy thing, and cryptocurrencies everywhere. We have digital banking. We have so many things now. All of those actually technologies. And we have to follow up with those technologies. And this is what where we can be subject for technology risk, technology risk. So the rapid technological innovation has also technology risk. As I told you, either we cannot get the right technology, or we get or we don't acquire the up-to-date technology. And we can talk about the payment system, we can talk about the security system, we can talk about anything, and we are left behind. So just to give you more examples here. So major objectives of technology is to lower the costs, to increase the profits, and to capture new markets for financial institutions. Now, here, I think we have talked about those concepts before, the economic of scale and economic of scope. We hope technology can increase the economic of scale, but when we talk about economic of scope, it implies that the financial institution ability to generate cost synergies by producing more than one output with the same input. So please understand the issue of economic of scope from this perspective. If we have, for example, same data, we can produce so many things and so many reports out of it. We can use data for housing loans to produce, as I told you before, new products, make new models for different products. So this is the economic scope, and actually this is with the help of technology. So this is also one of the problems of technologies. Investment may not reduce the cost, is the risk, to provide this, what we call it diseconomies of scale, which means technology investment may not produce the cost saving anticipated. Operational risk, existing technology or support system may just break down or malfunction. And this is actually another problem that will lead to bad reputation, and customer will just run away, and regulators will come, and so many problems. So example of these banks, all you can read about them, but as I told you, this is also not examinable. I mean, all those cases, okay? So just to this is all cases about banks, Operational risk also include fraud or errors, and this is related to people, as I said, by employees and managers. Okay. Now, this is our friend, which is liquidity risk. Liquidity risk is a very important issue, and actually we cannot pay the customers their money if they come. And if we don't manage liquidity, that liquidity will take us to a run. So the risk that our sudden surge in liability withdrawals may pressure financial institution to liquidate part of it. The liquidation of assets may have to happen in a very short period, because when we have pressure of liquidity, what would happen? I have two things. Either I go borrow from the interbank very fast, and I will borrow it with a very high cost of capital, which means because people know that I'm under stress of liquidity and they want to buy, so they will increase. They will look at me as a risky borrower, so they will increase their cost of capital and the cost of return, which will increase my. They will ask for more return, which will increase my cost of capital. Or if I have assets, I can sell them. And because I sell them, rush selling them, I will sell them under the market price. So either wise, I am making a liquidity risk. So the liquidation of assets, this is when we rush in selling our assets. The liquidation of assets may have to happen in a very short period, because you cannot wait. If you wait, people will just, when we say very fast, which means you need it in few hours, okay? And at very low prices, causing a lot of losses to the, so you have to sell it in very low prices. So that will, this is what we call it fire sale, okay? Which is less than the market price. Also problematic to liquid assets such as loans that cannot be liquidated, or new loans cannot be granted. So our loans cannot be liquidated, as I told you. The other thing is also, if we have opportunities to give more loans, because of this liquidity problem, we cannot grant new loans. So as you can see, the most important thing is the fire sale, which is I have to sell my assets less. And this is where the losses comes. The problem is also if I have a serious liquidity problem, which means I'm not actually reacting very fast to my customers and replying to their withdrawal, requests, then in this case, that will, just inflate some type of concern about the bank. And everybody, even if they don't want their cash, they will go and take it. And when one comes, the second will come, and we convert it, or we come under a new status called bank run. And the run can turn to a simple liquidity problem. So when people come, so I expect 5%, now they are 10%, suddenly I'm not, doing well, 20%, 30%. So that is a liquidity problem. And that will, finally, the bank will say, I cannot do, at the end, you cannot withdraw. And in this case, it's a liquidation for the bank. Problem from nothing in few days can collapse the bank. This is a liquidity problem. I told you to check Northern Rock. If you calculate for Northern Rock, they have a YouTube clip, and they have also, so many things online if you want to read. But again, there is a hint here, Northern Rock is not examinable. I give here, you can read about it here, but it's actually, it's a very, very, this has happened during the financial crisis. This is a British bank, and this British bank, actually, during the financial crisis, there was a liquidity problem in the US, expanded to UK, and people, and there was a little pressure on the withdrawal. The bank was not really, responding. And then Central Bank, which is the Bank of England, Central Bank of UK, say they will help them, and they didn't help them. End of the day, as you can see, around 80% of the customers, they want to withdraw. This bank was collapsed from one day, from nothing, it was collapsed. So this is the case of Northern Rock. Insolvency risk is very interesting. This is the capital, which I already talked to you about here, which is we are talking about this issue, just to let you in the picture. This one, when all these risks here, now all those risks we talked about are here. So we will deal with them through management systems. And then the capital will take the rest. So the capital is actually the last bot to take all of those, the buffer and the, our safety to withdraw, to absorb whatever come to here. If they don't, then we are going to bankruptcy. So now coming back here, as you can see, we are talking about original causes. So the risk that financial institution may not have sufficient capital. It's just you don't have enough capital to offset a sudden decline in its asset values relative to its liabilities, which means because of all those risks, your assets to your liabilities is decreasing. And in this case, you started to have all of those. If you cannot, it's actually a buffer for excessive interest rate, market risk, credit risk, off-balance sheet risk, technology risk. For all those losses coming from all those ones will go and be observed, should be absorbed from the capital. So both financial management and regulators focus highly on capital. This is why Basel III came to the picture, okay? And also the regulators in any country are very careful about that. You have to have enough capital. Otherwise, risk, as I told you, is a fact of life, and we accept it, we manage it, but we are always depending on our capital to absorb any problem. So we continue. But if we cannot absorb all the risks, then in this case, we are bankrupt. And if we collapse, we will collapse. Especially a big bank will collapse the whole system. This is why regulators are very, very careful about you have to have enough capital. Technically, look at this. Maybe I can show you this. I don't know how long time now. Look, this is actually those people, this is a distribution of risk. All of those distribution, it's one tail, okay? So it's actually, all of those is distribution. However, this is expected. This is the distribution of all losses. This is actually from here to here. This area is actually the, you remember, we have management. We have, for example, provision for losses. All of this is coming from the management. Coming back to that chart which I show you, all the management will absorb all the losses here. Now, after that, if we can know how much the distribution of all those losses, which then I can decide how much capital I should have. And therefore, the thing that I know that it will happen, like credit risk, I have to have provision. Liquidity risk, I have to have enough liquidity. So all of those things are not expected. I can deal with it here, which is the expected. The thing that I don't not expect, for example, suddenly there is a tsunami somewhere. Suddenly there is COVID. Suddenly there is financial crisis. Then losses started. The capital should be enough from here to here to absorb all those. This is the distribution of the losses that should be covered by the capital. If I reach to this point here, and I cannot, if the losses continue to here, then I'm gone. This is where actually the liquidity issue happens. This is where the bank has to liquidate. So I want you to understand it from this perspective. You can actually connect this area, this one, this box with this graph if you like. But I'm not really, I'm just for your understanding how bank works. But this is the graph how the issues work. Okay. Now, most risks, this is the last one. Most risks are actually correlated or interdependent. I will tell you something. Now, just imagine that there is suddenly a collapse I don't want to talk about Malaysia, please. Let's say there is a collapse in Dubai now, Middle East, or in Singapore, or even in Malaysia, in the market, equity market is dropped. What would happen now? This is a market risk. Equity market collapse. This is a market risk. Suddenly, all those people who are trading in the market are actually losing, which is most of them your customers. So your borrowers. So in this case, these people will not pay to you because they are only subject to those losses. So we move now to credit risk. Then, because of there is no enough cash flow coming to the bank, it's already have a market risk if they have investments, the bank. And also then now the credit risk is happening because people are not paying to you. And now, because there is no enough cash coming, you have what we call a liquidity risk. You cannot pay for your depositors, even the cash that is coming, which you was supposed to receive from customers cannot have. So all those cycles. So when we model risk, bank risk, we don't take a no model credit risk. We manage credit risk alone. We manage interest risk alone, but also we have to take some consideration. But when we manage the whole risk of the bank, we have new models, which means they will take the marginal distribution of all those risks and they come up with the end with the distribution to measure that risk. Now, some of you would say, oh, sir, you are talking now about distributions and statistics, whatever. I'm just giving you an example. Some of you, I think in econometrics, they know what I'm doing, saying, but for you who are not interested in those issues, the risk when we have, actually they are overlapping. So we want to take only the core of that, which is we call it, we take the marginal distributions, which means this is how we measure. We don't add risk. We use what we call risk matrix, and we take the core of those risks. So actually, this is the last slide. And what I want you to know is that there is too much, all those risks are overlapping. Thank you very much. This is the end of part 1. I will upload it for you. So I will just stop this. Thank you very much. And I will see you, and you will see me actually in recording part 2. Thank you. And I will see you in class also.